VCs across New England. And I also run a program called Tech Generation, which some of you might have heard of, but it's an internship program connecting hundreds of undergraduate and graduate students with Boston area tech startups for internships. And we have workshops and speed dating events and the application side. So if you have questions or are looking to get into a tech startup in Boston, let me know and I'm happy to help. I'll pass on to Mike.
Okay, can you hear me? Oh, awesome. Well, I promised Tyler I was going to make a public service announcement. I don't know if there's any, are there some Olin kids here? Yeah? No? That's awesome. I love it. All right.
Yeah,
well,
I ate lunch with them.
Well, anyway, so we were joking. We were here. I kind of facetiously started an organization called RARF, the Rotate and Revolve Foundation. There's, you know, the giant globe up on Map Hill. Back in the day, that thing used to rotate and revolve, and we wanted to raise money to make it happen again. But then Tyler was like, well, why don't some Olin kids just fix it? So anyway, if any of you want to fix it, someone should do that. Now you all know that it used to rotate and revolve, and it can do that again. Anyway, I'm Michael Mandel. I'm with Compstak. We are a crowdsourced provider of commercial real estate data. We gather commercial lease information in particular from real estate brokers, appraisers, and researchers all over the country. They share information on our platform, particularly on lease deals that have taken place, and are able to get other information in return. And then we end up with a comprehensive database of every deal that is taking place in the market, and we sell subscription access and a la carte access to that data to the world's top real estate investors and lenders.
Hello, my name is Polina Raygorodskaya. I'm the CEO of Wanderu. So first of all, there's a lot of seats out here in the front. I promise we don't fight. You guys want to come down and sit here so you don't feel like we're scared? No? Okay. So Wanderu is the largest ground travel search in North America. So we work with companies like Amtrak, Greyhound, Megabus, GoBus. We aggregate all their schedules and make the search and booking process for bus and train travel super easy. We've served millions of travelers since we've launched. And so if you guys ever want to take a trip to New York or New Hampshire or Philadelphia or anywhere you want to go, we help you get there, find the best deal to do it.
Awesome. Hey everyone, my name is Gupta. I'm the co-founder and CEO of NatureBox. I'm not going to talk a lot about what we do, since hopefully you guys have all tried some of our stuff. But really glad to be here. I was passing class of 2007, and lucky enough to live in eTower for a couple years, and hopefully we can share some of what we've learned over the last few years with you.
Awesome, thank you guys. So I think the first place to start with the conversation is to hear where you guys are each with fundraising, what round you're in the process of raising or just recently raised, so we can let you guys take from there. Mike, can I start?
Sure. So we've raised a total of $10 million in equity, as well as some venture debt money, which we can talk about too if anybody's interested in that. In a few different rounds, 2 VC rounds and one or two angel rounds, depending on how you count it. Happy to talk about that. Also, right now, in the midst of just kicking off a Series B fundraise for the company, which will be a much bigger round than we've raised in the past.
So we've gone through 2 rounds of funding, raised around $8 million total, and have dealt with both angel investors and then rolled that into that was during our seed round. We were raising angel money and then rolled it into a larger round because we had a VC come in that wanted to turn it into a bigger round, and then our Series A round was also VC funded.
So we've raised about $60 million across 3 venture rounds and then a debt round. If the stress of those 3 rounds hasn't nearly killed me, we may go out and raise another one next year. So it's been a fun experience.
Awesome. So you each talked about a couple of different types of fundraising: angel, seed stage, and VC, and you also mentioned debt, Mike. How do you know what type of funding is best for your company? Should you go for VC right away? Should you start with some smaller angel investment? How did you approach fundraising the first time?
I think Gautam should kick it off, because Gautam used to be a VC.
Yeah, so I actually had a really lucky sort of start to NatureBox, which is I started my career in venture capital, was leaving the venture capital firm that I was working for to start NatureBox. And so when I told them that I was going to leave, they asked me if we would consider taking some of their money. And the answer to that was obviously yes, we would be happy to take some of your money. So we had, fortunately, we had a really sort of easy seed round where we raised $2 million, and largely the majority of that money came from the firm that I used to work for. But I think the truth is that most businesses actually don't need and shouldn't think about raising venture capital. For technology businesses that are high growth and where you have to sustain long periods of expense and unprofitability, I think it can make sense. And in those times, or with those types of businesses, I think it's really important to think about what your value proposition to the investor is. And maybe it's the relationship that you have with that investor, like it was in my case. It's the domain experience that you have in a certain industry, or it's traction. You have customers, revenue, some sort of partnership that gives you an unfair advantage over someone that might be trying to start the exact same business. And I think if you can clearly articulate that, it's probably a good time to start thinking about raising funds.
I think you summarized it pretty well. I mean, one thing that I would add to that is I think people get really caught up in the idea of raising money versus the idea of growing really good businesses. So, and I think based on my experience and people I know, I think this is an even bigger problem in San Francisco, and I think that you can talk a bit about that because that's where he is based. But the idea of going to Y Combinator and raising as much money as you can. The realization is, all 90% of businesses fail, if not more, like 95%, right? When it's venture funded, the percentage may be a little bit smaller, larger, whatever, less. But in reality, the more money you raise, the higher the expectations are from you, and that money comes with a price. They don't just give you money and say, here you go, have fun, do whatever you want. If you raise a lot of money, at the very least you need to pay that money back before you see it for yourself. And then the terms get even worse from there, depending on how you negotiate those terms. A lot of people are like, okay, I want to raise as much money at the highest possible valuation, and get a TechCrunch article and feel really cool, but then they end up with really crappy terms that basically says that they don't see anything until a 5x return to the investors, and then you raise 20 million and sell for 100 million, you're not getting anything, right, at all. And you spend all this time building an awesome business that's your baby. I mean, there's a lot of ups and downs in building a company. So if you end up with nothing in the end, is raising that money really worth it, right? So when thinking about raising money, don't just think about, okay, how much money do I need, and can I raise as much money as possible? Think about what do I need right now that will get me to becoming more valuable later, and will get me the best possible terms. Sometimes it's better to take a lower valuation and get better terms, because in the end, and by terms I mean the other things that go along with valuation, like what the investors expect to get back before you see any of that money. And there are many other things that go along with it. How many board seats? Do you even get a board seat on your own board, right? There's so many things, control and stuff like that go into fundraising that are extremely important. And so when you start thinking about that, try to think about it from what's going to happen in the future rather than what's going to sound good in an article.
To just step back a little bit, let's assume that you've decided that you need to raise money, you think you're a high growth business and you want to raise money. There is a fundamental difference between VCs and angels, and I think you need to think about, what's the right stage. For most people, you're probably not going to raise VC off the bat. VCs are looking for traction, they're looking for a really well-established team, they're looking to see product market fit in some capacity. They want to understand that, they don't want to invest in, they want to invest in something that's high risk for sure and high return, but they're not looking for something that's not fully thought out. You get away with a little bit more with angels, but at the same time, you have to really, show that you've got your shit together, for lack of a better term. So I would say for most people, the likelihood is that angel investors is the way you're going to start. You're going to be dealing with, an average check size of, let's say, $25,000. So, when we were starting Compstak, it was a full year before we were able to raise any angel money. And until we figured out how to play the game. Then once we played the game, it actually became much, much easier because you learn kind of how to give your pitch, how to explain what you're doing, how to get people excited about it. And then, you know, you actually have to create a level of scarcity around the investment where people really, they are, you know, want to give you the money, where they're actually asking you if they can put it in and how much they can put in and what they can do. It's, you know, I guess maybe I was never very good at dating. I would imagine that if you are good at dating, you'd be good at raising money because, you know, you don't ever want the person you're going after to know that you want them more than they want you. And it's kind of the same thing, I think, with raising money. You want them to want you more than you want them, or at least for them to think that's the case. So I guess, you know, the short story is you're probably more likely going to go after an angel investment. You still need to show that you've got the right team that knows how to execute on the product. You ideally will have built some sort of product and have some sort of traction in the marketplace where people are trying it and using it and liking it. And the likelihood is that if you're thinking to yourself, oh, I've got this great idea, I'm going to go raise money, and then I'm going to do it, you're wasting your time. Like, there are people who've done that, people who are serial entrepreneurs who have a track record, who've raised money before, where people are willing to take a risk. But outside of that, it's very, very, very rare that anybody's going to give you money for an idea. And so stop wasting your time thinking about how you're going to raise money for your idea and go spend your time making that idea into something that somebody would want to invest in.
That's an important distinction to make, and just to kind of keep going a little bit on that thought, Mike, if you can, how did you learn how to play the game, as you said? How did you figure out the trick of making sure that the investor wanted you more than you wanted them, and playing that relationship? How did you figure that out?
So there's a couple things. One is a level of confidence and maybe even arrogance that you get out of having maybe been rejected so many times, where you could go either one, you know, two directions. You could like be dejected and just decide I'm done, I'm not doing this, or you just like, you know what, my idea is so freaking good, what I'm doing is awesome, I know it's awesome, if you don't believe it, forget it, like I'm not interested in you. You know, you have to have this level of confidence where, and that comes through in what you're pitching. The other thing I would say is having a truly big idea. If you're looking to raise money to grow a business, the assumption is that whoever wants to invest in you, whether it's an angel or a VC, they want to get a 10x kind of return. So the bigger the idea, the better. So, you know, when we were starting, we were, you know, crowdsourcing commercial lease comps, records of commercial lease transactions that have taken place. No one was investing in the commercial real estate tech space at all at that time. There was no interest in the industry. Now there's a lot of interest in the industry. And people were just like, it sounds like a niche play. Like, why do I want to invest in that? Like, whatever. And at the time, we thought, if we could raise $500,000 total, that's all we'll ever need. That's it. Now we spend $500,000 a month. But at the time, we thought that would be amazing to raise 500. Wow, wouldn't that be great? And we were going to be the lease comp guys. And then I would sit in these meetings, and people on the other side of the table would say, well, what if you did this? And I'd say, oh, that's really interesting. Then I'd go to the next meeting, and I'd pitch the idea that the investor gave me the meeting before. And they'd say, oh, that's really cool. And then they'd say, what if you did this? And next thing I knew, the idea got bigger and bigger and bigger. And every time the idea got bigger, the investors got more interested. So, you know, we went from being the lease comp guys to the, you know, this marketplace for commercial real estate data. And then from the marketplace for commercial real estate data, we became the Bloomberg of commercial real estate. And then from the Bloomberg of commercial real estate, we're like, what if we were the New York Stock Exchange of commercial real estate? And every time it got bigger and bigger, it was like this huge opportunity. And people were like, okay, this, you know, people want to invest. People and VCs want to invest in people who have big visions, who have a big view, big picture of the world, and they get excited about that. And you want to get them excited. So, however big you think your idea is, I would say, think about it being bigger and don't be afraid to be confident about it. But at the same time, you can't be like pie in the sky bullshit. You need to lay out like a very clear plan as to like how you're going to get there that is much more reasonable to start. Like you don't take on everything at once or else you look like an idiot.
So I think the best way to play the game and care more than the other people care is to be in a position where you can care more, or care less than the other people care. Is to be actually in that position, right? So you can fake it. You can be really, really desperate and try to fake it, but the problem is when you're desperate, no matter how much you try to fake it, it kind of just like an aura of desperation around you, right? Like you're like, ah. Like after you've gone through like 100 meetings and gone through 100 rejections, it's really, I mean, maybe he's really good at playing it, but it's really hard to get to a place where like you've been rejected 100 times and now you're like, I am the shit, you need to give me lots of money. You can try, but usually there's that like aura of desperation. The best time to raise money is when you don't need the money. And it's really easy to say, you know what, I really don't care if you give me money or not, because I don't need it. Look, I have, you know, $10 million in the bank, we're growing super fast, we're gonna be at break even in like 6 months. The reason why we want to take some money now is because we're growing so fast that that money is going to help us grow even faster, so that in 6 months instead of here, we'll be there, right? And at that point, and of course, this isn't later rounds, right? When you're just starting out, that's hard to do because it's really hard to say, I don't need your money when you are like, you know, starving on ramen noodles and living at home with your parents and, you know, working out of your garage. But when you get to a place like, you usually don't want to wait until you only have 2 months of runway left to raise a round, because at that point you're just like freaking out and it's really hard not to sense that. And also the investors can see your financials, so they're like, okay, so your burn's $200,000 a month and you have $400,000 in the bank, so you have 2 months to live, so you basically need my money. And it's also really hard to negotiate at that point, because they're like, hey, sure, we'll give you money, but here, you're gonna have to take it on my terms. So the first lesson is, you know, try to raise money when you have at least 6 months in the bank, but ideally more, right? Start talking to investors, start building those relationships. And the second bit of that is, you know, just, you have to, yeah, confidence is extremely important, but so is demand, right? So going back to the dating analogy, right? So when you have one person that wants you really bad, right? And that's the only person that wants you, you're like, that person's looking pretty good, it's the only person I have, you go with that, right? And when you do that, that person's like, well, nobody else wants her, so maybe I shouldn't want her, why does nobody else want her? And then like, it becomes this awkward situation where like, you're like, all right, fine, I want you to, and then they're like, actually, I don't really want you anymore, and you're like, what the hell, I didn't want you in the beginning, but now I'm like, you know, now I don't have you either. So you kind of want to get in a situation where you have like 3 or 4 people that really want you, right? Because those people feed off each other, right? Like, investors are human beings, right? Like, and it's, again, very similar to the dating game, where, you know, you naturally want what other people want, because somebody knows something about them, right? And the way that it works, it's really funny how it works. Like, the second you have a couple people really interested, all of a sudden everybody's really interested. But with the same exact company, same exact timeline, if you talk to one investor at a time, and you get really far with that investor, and you get to the point where you are close to maybe closing something, that investor may get second thoughts. I mean, we're talking millions and millions of dollars that they're about to put in. They're like, wait, if there's nobody else that wants them, maybe I'm not making the right decision. But if you're in that same, if you go start talking to like 10 investors, and then 3 of them end up getting really far, and you're at the stage where they're all ready to commit, then one, you have options, right? You can say, hey, I got better terms from them, so let's work this out, because I really like you. But on the other hand, you also have, it's less likely that they're going to lose interest because everybody else is interested. And there's this big FOMO in the investor community, fear of missing out. So when everybody else is interested, you better bet that they will be interested too. So those are, for my, oh, and then one last thing, don't raise money in the summer or during the holidays. Just a waste of time.
There was a lot of good stuff in both of what they said, and I was going to tease Mike about the dating analogy, but I mean,
When I can't, because
Been validated.
So I think a couple thoughts. So the first one on fear of missing out. You know, the weird thing is that almost every one of your investor meetings ends with the question of where are you in the process. I don't know if you guys feel the same way. So you know, your investor or this prospective investor is asking you, well, where are you in the process? Are you meeting with other people? When do you expect your first term sheet? Going back to the dating analogy, that's like ending a date and being like, so how many other people are you dating? You know, where do we stand? So obviously, like the fear of missing out is a really big thing, and you know, I think you can play that to your advantage. If we go back to raising your first round of capital, I think it's as simple as this. Play into your strengths and try to fix your weaknesses. And what I mean by that is, you know, in every case, you're going to have certain strengths, right? Maybe the market size is really big, or maybe you have, as a founder, some really unique experience that makes you pitch your business and when you talk to investors. But maybe you have weaknesses as well, like you haven't built out your team, or there isn't a lot of revenue traction. And I think you can actually find creative ways to work around some of those things. On the team front, you can build a board of advisors, right? Which then show the investor that you're willing to bring on smart people and you know that you need to build a team around you. From a revenue traction standpoint, you can try to develop a partnership or get some initial survey feedback even to prove that your concept has traction. So I think I would think creatively when you're starting your business of how to answer some of the questions that an investor might throw at you without needing to have sort of all of the data that it might take months or years to go out and get.
To piggyback on that, so investors are all about seeing your trajectory. Everybody knows the classic hockey stick. Well, it exists. Everybody wants to see a hockey stick in everything. It's not just revenue. It's whatever your metrics are for your industry or your type of business. They want to see the hockey stick type growth. But one thing that worked for us, and I've given this advice to a lot of people, is your business and your industry better than anybody. And this maybe applies a little bit more to us where nobody knew anything about the commercial real estate space. But if you're in a niche industry, you can get away with this a little bit more than if you're in an industry that people know a little better, like like subscription businesses, where there's very typical metrics that they look for in subscription businesses. In our industry, there were no set metrics necessarily, so we made up our own metrics, and it works really well because basically, okay, we didn't have huge revenue, so we couldn't say we had huge revenue. And user growth, like we're in a niche, the real estate industry, we're a small group of people. Like talking about millions of users isn't going to work for us. So we're like, data growth, comps. We're a comp business, we're a lease comp business. Let's talk about our comp growth. And then so basically we're like, okay, well that's interesting. Well, we have 20,000 comps, so we're going to tell the investors that we actually only were looking to get 5,000 comps at this point. And look, we're at 20. We're at 4x what we look out to get. And last month we were at 20,000. So that's actually 10x what we were planning for last month. Our growth has just been incredible. And I'm being a little facetious, but the truth of the matter is that you need to understand what is really great for you and for your business, and you need to sell that. You sell what you have at your disposal. To Gautam's point, you're not going to have everything working all the right ways, but that doesn't mean that you can't sell what you do have and paint that picture and make sure you tell the story that people want to hear.
Awesome. So Gautam, you talked about getting your basically first investment from the firm that you were working at, which is a pretty unique scenario. But I'd be interested to hear Polina and Mike about your experience with how you approached raising money the first time, and then what it was like when you got that first investor to sign on.
So I actually have a really funny story about my first investor. So my professor, Brad George, who maybe some of you have, I don't think he's here right now, but I think some of you have him, he's Professor Babson, he's my entrepreneurship professor. And he invited me to come speak in his class back when we were just starting out. I mean, at that point we had an idea and initial founding team and some really early traction with interest from plus partners, but we really didn't have anything built. We didn't have much of anything, and so I came to the class and I I told them what we're doing, and I had a previous business that I started when I was at Babson College. It was a PR firm, and I was in Len Green's class and running the business basically out of classrooms. And so I talked to the class about my previous businesses, and then I talked to the class about my current business that I'm starting. And after giving the presentation, one of the students approached me and said, I really love this idea. I take buses all the time. This is awesome. There's nothing out there that solves this problem. Are you guys looking for money? And I'm like, at that point we weren't even thinking about looking for money because we had a free office space. By the way, great way to get through, the initial stages when you're starting a business and don't have anything. Mass Challenge, if you get into Mass Challenge, you're a finalist, they give you 4 months of free office space. BU no longer has this, but they had an incubator program where if you had any affiliation with BU, they gave you 1 year of free office space, which is a long time. And I don't know if Babson gives, I think to students Babson gives free office space too. So there are resources there for free office space. But anyway, so at that point we weren't raising money or anything. Like, we weren't even thinking about raising money. We needed to get some sort of product out there to show to people. But I said, you know, we're not raising money. Of course, see, it's always good when you're not raising money. But you know, we're happy to like walk you through the product, put together a presentation. Well, no, he said, you know, my father is an investor, and you know, I think that he would really like this business. And so we ended up, you know, bringing him to our office at BU and walking him through a presentation. He sent it to his father, and they ended up being our first investor. Yeah. So, so that was a very interesting experience for me. It never happens quite like that after that, but ended up getting really lucky there. And then from there, kind of started rolling, you know, angels into the round because we took that money. It was somewhere in the summer. Then we took our second check, which is another angel investor. We were part of Mass Challenge. It's, you know, free to be a part of it. You don't have to give up equity. I highly recommend it. They give you access to an incredible mentor network. And I think that a lot of people don't realize that, you know, Mass Challenge is not going to hand you, you know, make things easy for you. I'm not just going to hand you, like, here's the people you need to talk to. I spent, you know, half of my time in Mass Challenge going through the mentor network, emailing people that I thought would be useful, whether they're investors or somebody that can contribute to the business, and saying, hey, let's meet for coffee. And that's how I met my second investor, who's Sinan Dukach, who is now running TechStars Boston. And so we met through the mentor network. We had lunch, and he ended up, after lunch, basically writing us another check. That was several months later. And then our third investor was the chairman of Orbitz, who was it's all about introduction. I mean, basically, you build a network, but I came in here with no network. So how do you build that network? You look at people that can make introductions, whether it's you know, friends, family, whether it's, you know, people, Babson alumni, look at the Babson alumni network, or, you know, be part of things like Mass Challenge. There's also other accelerators like Techstars and, you know, Y Combinator, so on and so forth. That's a great way, 500 startups, it's a great way to build a network and get access to get those introductions, because it's really hard to cold call investors and get money out of them. In fact, I don't think that that's ever happened for anybody I know, where you just pick up the phone or email and say, hey, give me money, right? Usually you need to get introduced to those investors.
So I would say that the number one, like, if there are two words I can give you that you should live by for like fundraising, the words are forcing function. You need a forcing function to get investors to actually give you money in any round of fundraising, I would say. And if I think back on like every fundraise that we've done, everyone had a different forcing function. So the first forcing function we had was we said, we've got all these people interested, everybody's psyched, we're capping this round at $500,000, we have interest from about $750,000, and we're going to close this out on June 30th. And if we get, you know, more than and once we hit 500, we're closing it out. So you have to have your money in by June 30th, and you have to, you know, make sure you get it in before other people. We're closing it out at 500,000. And like it was, you know, whatever, it was what it was. But we ended up getting, I think, like 300,000 by June 30th. But that was fine, because that was the first money we raised from a bunch of different angels. And once we had 300,000, then you go to everybody else and say, I got $300,000. Don't you want to be part of this club too? So then, like, the next forcing function we did was we got into 500 startups. We said, you know, we got into 500 startups. We're going to be, you know, that's raising our profile. We're going to raise our cap on our note so we're raising our valuation. So if you want to get in, you better get in before we start 500, because then our price is going up. So that was forcing function number 2. The third time we raised angel money, we were gearing up for our demo day for 500 startups. And we said, we're about to have our demo day. After demo day, valuation's going up again, so you better get in. We're going to close it out at the end of the year. And each time we did raise our valuation, every time along the way, we just, you know, do a forcing function. And then once you get to the stage that you're at VC money, the forcing function is like Gautam was alluding to, the pressure of other VCs getting in on the deal. And then it's all about running your process very, very tightly, so you've got everybody at the same level of interest at the same time, so ideally you can end up with term sheets at the same time, to then, and the pressure of those other VCs investing, doing that. And by the way, I've learned, you know, a good amount of this just sort of figuring out along the way, and everything else I learned from Gautam.
I was gonna say Mike.
I would love to know what the forcing function is in the dating analogy, but we can talk about that.
We'll talk about it after.
So then how, that really threw me off, Gautam. I like stop thinking about what that could potentially be. So then when you're approaching investors, I mean, introductions are obviously huge, right? Cold calling somebody is really, really impossible. So how do you tap your network effectively and take advantage of introductions so you don't, at a certain point, you stop feeling ashamed for saying, hey, can you introduce me to one more investor? Or like how do you do that, and then also how do you create that target list of investors?
Yeah, so I was going to say, so the point that was made earlier, I think Polina mentioned, like don't cold call and cold email investors. Speaking from the investor side, whenever we would get cold emails or cold calls, those would just go into the trash. So I don't even think I ever even read those emails. So I would definitely agree, like that's just a waste of time. So even though it might be easy, it's just a waste of time. Getting those introductions is actually relatively easy. I think it goes back to building your network, making it really easy for the person that's going to introduce you. So drafting them a note that they can just forward and sort of make the introduction that way. I think the biggest piece of this that a lot of entrepreneurs forget is it matters. The quality of the introduction matters a lot. And so when I've asked for introductions from friends, it's usually from someone who that investor has invested in. And I do this a lot for my friends, right? Anyone that's trying to reach my investors, I'm more than happy to introduce them because I have a good relationship with them. Hopefully that investor thinks that I have good judgment and that I'm not just sending shit, to them. But I think quality of introduction matters a lot. So I would try to get an introduction from someone who actually knows the person, has a working relationship with them, and not just someone that they met them at a conference 3 years ago or something like that. I would really save those bullets for when you need them.
Sorry, no, I would just say, Gautam mentioned making it easy. Making it easy means like you take your story of what your company is and you put it into a quick few sentence, like little paragraph, and you send it to your person who's making the intro, and you have it, and you can even draft email for them saying like, dear so-and-so, I'd like to introduce you to my friend Michael. He's got this great business that does blah, 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 and you now forward it to Gautam, and all Gautam needs to do is hit the forward button and send it through, and that's it. Like, you're dealing with busy people, and you're asking them to do you a favor. You have to make it stupidly easy on them. Don't make them have to explain your business, or even have to think about how to position it. Make it super, super easy.
So one trick that I heard from another entrepreneur that worked for them. So if you absolutely have to do cold emails, don't have an introduction to an investor that you really, really want. And I haven't tried this, but someone else did, and it worked for them. So first of all, when you figure out that you want to raise money, one of the first things you need to do is figure out who you want to raise money from, right? So just like when you figure out that you need to go to college, you don't just say, I'm just going to apply to every college out there, see where I get in, and then see how it goes. No, you say, I want to go to a college that's good in entrepreneurship, so let me narrow down those schools, pick my top ones. And with investing, you usually want to pitch, you don't want to pitch your reach school first. I don't know how to say that in a nice way, but basically you want to get your practice out with, maybe even investors that are not even in your realm, and you just like, they're willing to talk to you for whatever reason, you're willing to talk to them, and just see what feedback they give you, because that feedback is what you use. You usually want to say, and this is really in the beginning stages when you're figuring out how to pitch your first round. Nobody gets it done perfectly. I mean, my pitch has changed so much from the beginning to where it is now, and I already anticipate what questions the investors are going to ask, and I make sure to answer them before, because otherwise they're already thinking about it, they're not even listening to the awesome part of your business, because they're like, oh, there's this problem there, this problem there. So you're like, okay, I know what problems they see, I'm going to address those head on from the very beginning. They're going to be shocked because they're not even going to know, like, hey, she's got everything covered, right? So the trick, right? for when you have to cold. So you create this list of investors that you want to target, right? Well, first you want to create a list of funds, probably the funds that are relevant to your industry, whether, my industry is travel, so what funds can provide me value, whether it's travel or consumer. I'm in travel and consumer, I'm probably not going to go after a life science fund because, one, they're not going to know anything about my business, and taking just money is not enough. I want an investor that can provide more value to me than that. And so, create a list of funds, and then from there you want to create a list of partners that you want to go after. Partners are extremely important. You can have one fund that has a variety of very different partners. Some you definitely would never want on your board, and some you would love to have on your board. So just saying, no, I don't like this fund, is not like, it really varies from partner to partner. So after you figure out what funds are relevant to you, you want to pick out what partner you would want, right? And it's hard to know that without talking to them, but at least have an idea of who they've invested in the past, maybe talk to some companies that they've invested in. But anyway, so once you have your target list of partners, right, then the challenge becomes who can make introductions to you. And if you don't have if you have this partner that you really, really want to get an introduction to, but you don't have anybody, and you spent lots of time trying to figure it out, couldn't find anything. So one trick that somebody I know did that worked for them was they looked at, so there are lots of big conferences that many of these VCs attend. One of them is TechCrunch Disrupt, which I think is happening this week in San Francisco. And most of the major VCs go to this conference, right? And I think there may even be a way to track down who's there. So what they did is, after a particular conference and a few months later, they found the email of this VC and emailed this VC, following up from TechCrunch. Had never met this or talked to this VC before, but the thing is, VCs talk to so many people that although they don't remember, it's like, it was great speaking with you at TechCrunch, you showed a lot of excitement in my business, right? So I just wanted to follow up because back then we weren't raising money, but now we are, and this is, all the traction that we've had since then, right? And this VC ended up getting back to it, so he sent this email to the VC, they got back to him within an hour, great to hear from you, let's set up a meeting. And they had never met before, they'd never talked before, but at that point the VC's like, well, this person's so confident that we met and I've seemed excited in their business. He's probably met 200 people since TechCrunch, which happened 3 months ago, that odds are maybe I did meet him and forgot, or maybe I was drunk, I don't know. Right? But he got him to respond and ended up going and doing a pitch and got all the way to a partner meeting with that fund, ended up going with another investor. But he told me this story, and I was like, someday I will try that too. But there you go. So if you have to cold call, be creative about it.
So you talked a little bit about this too, and I think it's relevant for investors with selecting your board as well, because that's building your initial network and your initial kind of champion group of people that are going to believe in you as an entrepreneur and believe in your idea and your company. How do you select those people and then work with them through the fundraising process?
Well, so I've had good board members and bad board members, and building your board is incredibly complicated, and I think I think the one piece of advice that I give is don't rush to build your board. We were 2 years into NatureBox before we even had a board, and I think realistically your investors get to, if you've given them board seats, they get to pick who's on the board. So either you like them or you don't like them. It's very, very difficult to get an investor off your board. Well, it's actually, I think it's probably impossible to get the investor as a firm off your board. You can get the partner off your board, but that's very hard, and it's a lot of political capital. I think independent board members, ideally you're looking for, so my independent board members were, I had the founder of Pop Chips, and then I had the ex-CFO of Netflix. And they were both incredibly interesting people, very, very different. The ex-CFO of Netflix was in his 60s, and he'd come into board meetings and yell at people, tell us how much we're all idiots. But he was phenomenal. He was incredibly valuable, and I actually have a great relationship with him. But I think you want to create a board dynamic where people are incredibly transparent. People come into the board meetings prepared to give feedback, and they're not going to hold back. And I think you want board members who are not just going to go with whatever the VCs say, but they're going to give you different opinions and things to think about. And realistically, independent board members usually have terms, so you might give them a 2 or 3 year term. And if it's not working out, you can have that difficult conversation of, hey, this isn't really working out the way that I thought it would. We should talk about making you just an advisor and opening up that board seat. But I think you want to look for board members who think they can add value, they want to learn, and they're in it for your success and the company's success. I think those are very, very important qualities. They shouldn't be in it for the money, they shouldn't be in it for the sort of image or the credibility of being on a board.
And for the CFO of Netflix, I mean, the expertise that you were having there was his knowledge of subscription service, of...
Yeah, so he actually basically ran Netflix. The CEO of Netflix is a guy named Reed Hastings, and Reed is a really talented engineer. But his CFO really ran the day-to-day business, and he was there from $1 million of revenue when Netflix was at $1 million run rate, all the way up to 1.5 billion, and took the company public. And so he had a very integral role in building Netflix.
Yes, and then was able to apply the same expertise to NatureBox.
Exactly.
Cool.
I would just reiterate what Gautam said, that you don't want to create a board until you need to. You're going to be required to have a board once you take VC money, but there's no real practical reason to have one ahead of time. If you want advisors, get advisors, but you don't need to have a board of directors to have those advisors, and it only creates more structure and more challenge when you need to change that board when you bring in the VCs. So why give yourself kind of the headaches when that happens? There's the concept of an advisory board, which I think Polina might have mentioned. You mentioned advisory, maybe Gautam mentioned advisors or advisory board before. That's a whole different challenge as well. I'd be very cautious about advisors too. Advisors are great, but at the same time, you have to be cautious about people who ask for advisory shares in your company, or who want to become too active, and you don't know exactly whether that advice is advice you want or not. Part of the biggest challenge I find as an entrepreneur, and I've sort of heard the same thing from a lot of other entrepreneurs, is that 99% of the time, you don't get what you want out of your advisors, and 90% of those times it's your own fault. It's because you just don't have enough time to reach out to them to ask them for help. And it's not their job to call you every day to solicit advice, and they don't even know what they're calling you to give you advice for. So you don't call them, they don't call you don't get that much value out of them, and a lot of times you end up giving them equity in your company, and they're not actually doing anything for you, even though they could and they're well-intentioned, but it's just not working out. So just be very cautious about giving out advisory shares and setting up advisory relationships. Having mentors and advisors is awesome, but you have to really understand and think about how you structure those relationships.
Thank you. And then before we open it up for questions, I think we've got one last question for each of you, which is, what is one thing that you wish you'd known before you took on the life of an entrepreneur and fundraising? You touched on it a little bit, but one big thing that you learned, and one thing that you wish you'd known, or maybe something you wish you hadn't known, like maybe the burden of having been an investor before was a lot, or maybe it's helpful.
So I'll kick this one off. I mean, I think I mentioned most of the stuff that I've learned. I mean, again, I'm going to reiterate this again just because it's such a waste of time. Don't raise money in the summer. Literally, don't do it. If it's basically if your 6-month window is gonna start in May or June, you should start in 9 months out instead of 6 months out. So, because everybody's on vacation. The thing about, at least for VCs, right? For angels, it's less important. For angel investors, you could have, I had angel investors, I did a call for 15 minutes, and they wrote me a check for $50,000. I still haven't met them. I have angel investors I've never met. Awesome people, right? But with VCs, most VC funds require a partner meeting and partner approval, right? And so that process in the summer is virtually impossible because I'm sure you can talk about this more, but it seems like most of the VC community is on vacation for the entire summer. And so you get bar with one partner, and then you try to do a partner meeting, and maybe only two of the 6 partners are there, and then the 3 of them are into it, but then one of the partners who happens to be away and missed it was like really not sure about this industry or business, and they need to be there, and these three can't move forward without them. And by the time, oh, the other thing is time kills all deals, right? So the longer that deal drags out, and the summer is the perfect time for your deal to drag out because everybody's on vacation. You can't get everybody in the same boardroom in the same week because like every single week someone's out. And so you end up dragging this out for months, and by then the deal is dead because that initial excitement is gone. That's like after that period of time, people figure out that, you know, oh, this is what's wrong with this, so this is what's wrong, and now I'm afraid to put money in and all this stuff. So just avoid the summer. That's all I got.
I was still thinking actually. So I think the summer point is a good one. I think it's probably more true out here than on the West Coast.
I was in the West. Actually, no,
but it is kind of funny because yesterday I was catching up with a friend of mine who's in VC, and he was like, I was asking him, so how's your summer? And he was like, yeah, I had a really busy travel schedule in June. So I basically just stayed on the Cape from like mid-July till now. And I was like, wow, that's awesome. Like that is a great life. So I do think August historically is probably the worst time to raise venture capital. The advice that I would give you is just get it done, right? Like if you're raising capital, the most important thing to keep in mind is just get the round done. I think when you start out in these processes, you have like stars in your eyes, and you're like, yeah, I want the best price, and I want the best type of investor, and I would say all of those, like it's good to have that level of optimism, but don't get caught up in things that don't materially change the business or change your life. At the end of the day, if your business needs capital to continue to live, your job as founder or CEO is to put capital in the bank. And so just don't get lost in the process, and make sure that you keep your focus on just getting it done. It doesn't matter what the price is, it doesn't matter what the terms are. I mean, it does matter if you have competition, in the deal, you should try to get the best deal that you can. But just keep in mind that, you're running against a ticking clock.
So, since most of you will probably be raising angel money before VC money, I'll give a piece of advice for angel money, and that is get the money in the bank. I always hear early stage entrepreneurs saying, "Oh, I have $500,000 committed." Bullshit. There's no such thing as a commitment. There's money in the bank and there's money not in the bank. Until somebody's giving you money and it's in your bank account, commitment is nonsense. And don't tell me if you're trying to get my money that you have commitments either, because it's absurd. So get the money in the bank. If somebody has a commitment if you have a commitment from somebody, say, great, here's my bank account number, you can wire the money here, then add them. If you're using AngelList, I don't know if people are still doing this, but what I would do is I would add them as an investor. I think you maybe gave me this tip, I'm not sure, but I don't know. I would add them as an investor on AngelList. As soon as they say, yes, I'm giving you the money, then they get this email from AngelList saying, you've been added as an investor to Compstak. And then, of course, they're not going to not wire you the money then, because then they feel like a jerk. So, you get that commitment, you send them the paperwork. The minute you get off the phone with them and you send them your wire information and you say, great, here, send me the money, and assume that it's done. That's what I would say. Take the money.
Yeah, I'm just going to add to that. There's a little bit of paranoia in me that I think is actually really healthy. Like when we were doing our last round, the signed term sheet, the signed docs, like we were taking a couple days longer. And I don't think I slept until we got those signed docs. But I think there's some amount of paranoia that is very healthy. So if someone says, hey, I'm totally committed, and then you give them this wire information and you don't see a wire come in, like I would not sit idly by thinking like, oh yeah, no, that money's good. I would probably start to worry a little bit. And I'm very proud of Mike for censoring himself today, because there are a couple times I think I know what you were about to say.
That's bullshit. There was no situation where that happens.
But yeah, it's good.
So now I can't help myself to give one more tip as it relates to that, which I'm totally forgetting what I was going to say.
Paranoia.
Something around the paranoia. I'll come back to it.
In the meantime, I think we can open it up to questions. So yeah.
Yeah, this question's for Gautam. First, I wanted to say I love NatureBox. I've been subscribed for a while.
Nice.
we have a product-based business instead of service, so that takes some additional capital to start.
Yeah. So the validation for us, Ken, who's my co-founder and also Babson grad, Ken and I started the company. We put some of our own money in, and we basically wanted to get to 1,000 subscribers before we went out and raised the rest of our seed money. So the first check was cut by the firm that I used to work for, and then we basically used that money for 3 or 4 months to get to 1,000 subscribers. And just to give you a sense, like 1,000 subscribers was about $250,000 revenue run rate. And we felt like if we could go into meetings saying, hey, in 3 or 4 months, we got to $250,000 revenue run rate, this is why you should give us money. Like we felt like those meetings would be really productive. And that kind of was the strategy that we've used a few times, which is like, if you have some money in the bank, spend into growth, and go raise capital when the charts, when the hockey stick effect is happening, so that you can kind of go into those meetings and say, hey, look at how fast I'm growing. Wouldn't you want to buy a piece of this company, right? So, okay.
This is for anyone who wants to take it. When meeting with investors, how do you balance selling them on your amazing dream and being transparent with the fact that you don't have the answer to everything?
It's not really something you have to balance, right? Like you can be transparent and sell them on the dream. So it's just about how to, you don't have to. They're not in the antithesis of each other. So it's, oh yeah, so our revenue right now is just $10,000 a month, but we're doing this, and this, and we're expecting that it's going to get us $100,000 next month. It's just having an answer for those things and an explanation as to how you're going to achieve them. You're not expected to have everything perfect right now. But that reminded me of the thing I was going to say, which is that particularly when you're dealing with angel investors, if they're asking too many questions and they're dragging out for days and days and days into weeks into months, and they're asking you for detailed financial projections of this and an assessment of this and risks of this, just walk away. They are not going to invest. I guarantee you they're not going to invest. In the off chance they invest, they're not an investor you want because they're just going to piss you off forever. So you just don't want those people. Like a sophisticated angel investor knows that they're investing in something very high risk. And they know that as an entrepreneur, you've got limited time, and dealing with them is not your priority. And if they don't understand that, they shouldn't be an angel investor, and they shouldn't be your angel investor.
So I just want to add one more thing to that. And I don't know if this is exactly what you're asking, but one thing that I learned really early on is you need to be careful about focus and not trying to say I'm going to be doing 10 different things at once, because that kind of scares investors, right? So for instance, for us, right, my long-term vision for Wanderu is to create a travel brand for millennials, right? But we're a Boston Train Travel Search. When I go and pitch investors, I'm like, now I pitch kind of the bigger vision, but I still focus on where we are. But when I was just starting out, it was we're a Boston Train Travel Search, right? We're not and initially I was like, oh, we're going to do Boston Train Travel, and then we're also going to do this, and then we're going to get advertising revenue, and then we're going to get revenue from here, and then we're going to get revenue from there. Investors are like, oh my God, there's no way this is going to ever work. I'm overwhelmed, and no way. And then I realized really quick that you need to focus on, okay, what am I going to get done in the next 18 months that will be big enough, and then you can hint at future where you want to go as a company, but you don't want to start talking about 10 different sources of revenue and projections on each source, because for whatever reason that scares them. So that's one thing when you talk about kind of the bigger vision. It's good to allude that there is possibility for other things in the future, but make sure they understand. And it makes sense, right? If you try to focus on 50 things at once with very little money, there's no way you're going to achieve all of those 10 revenue lines with the amount of money you're raising anyways, right? So you focus what can I achieve, and show them with this I can achieve this, but there's a value of this as a bigger vision. So it's really important to stay focused on where you're going now.
So based on the position of an investor, what are some of the things that you need to consider and develop before you become an investor? Because based on what you guys have mentioned before, the entrepreneurs seem have the ability to attract
and just to be clear, I don't think any of us are advocating like lying.
No, I was advocating.
Yeah, I think Mike may have taken it a little far, but I don't think he's sort of encouraging anyone to.
And by the way, Gautam is an investor in Compstak, so
That's right.
what does that say about him?
I bought into it. But I think look, the truth of the matter is that it's a seller's market. So it's a very good market for entrepreneurs to raise capital. Investors are fighting to get into really good deals. And I think you obviously, so once, and I think we brought up the aspect of a term sheet earlier, but a term sheet is basically a document that outlines the terms, the valuation, and the size of the investment that both parties sign. It's non-binding though, so usually you have some period of time after you sign that term sheet where the investor gets to do their due diligence, and so that means that they can go, do whatever, look at your metrics or do the legal diligence, and so there are cases, and I saw this in my old career, where maybe the numbers just didn't add up, and as an investor you can walk away. It's very, very rare, and I think frankly, like if that case happened, because as an entrepreneur you were outright lying to an investor, you've got a big black mark on your, sort of call it resume. But I think the investor has the time to do their research and to do their work. And as the entrepreneur, you just want to get money in the bank. So I think there's a little bit of a balance to that.
Sure, but VCs and angels are very different. So that's the way it works with VCs. Angels don't have like a due diligence period. You might send them financials. The reason why I'm saying that someone's wasting your time, if they're asking you for all this stuff, is because most of that stuff is, to use the word bullshit yet again, most of that stuff is bullshit when you're raising your seed round. You're too early on to have solid projections for anything. There's not much to really audit on their part. They're either going to buy into the dream or they're not. When you get to a VC round, there's a lot more diligence, and there should be, and that's fair.
Yeah, just to give you a perspective, I think we mentioned, like, Polina has angels that she hasn't ever met in person. I have angels at NatureBox that I haven't seen in 3.5 years, and that like never call, and those are the best kind of angels. But I think like, look, if you're a high net worth individual that's going to take on the risk of making startup investments, as soon as you cut that check, just assume that you've lost the money, right? And if you get anything back, awesome.
Is there such a thing as too many investors?
I mean, so yes, there is, and first of all, it's especially an issue. So when you have angel investors like we have, which are really great, they provide value, and we send monthly updates to our investors, right? And usually in the monthly updates we have asks. The asks are like, hey, we're hiring this person, or we're launching an app, share it with your friends, or whatever it is, right? So in that case, it's really helpful to have a big network of people that you can send it to. The big issue becomes when you need to do something with your company and everybody needs to sign off on it, right? So if you have like 100 investors, right? Angel investors, and we don't have that many. We have like a pretty sizable handful, but it's like tolerable. I know people that raised like $5-6 million only from angel money, and we're talking like $1,000 checks. Like that is a lot of investors. So the problem becomes if you want to raise another round of funding, or if you want to sell your company or IPO or do anything, right, where it requires shareholder approval. That process becomes really cumbersome because you need to get signatures from majority. Right, so if you have 100 investors, when you have 10 investors, majority is like, 6 or whatever it is, right? When you have 100 investors and many of them are not active, like some of them may not even respond to your emails, maybe like some of them moved, it's been like years since they invested, they've forgotten about you, right? And it happens, like believe it or not, it happens. Anyways, and then you have to get those signatures. First of all, you have to answer a million questions, right? So if you have 100 investors and you're raising another round of funding, all of a sudden they really care about those terms, even though like they have no control over those terms, but like they ask a million questions, they want to get lawyers to review them, and like all this stuff that like many of them don't care, but that I think the biggest problem and the biggest thing to worry about is investors that don't have experience. Investors that don't have, going back to what both of them actually said, that like if an angel investor is asking you a million questions, odds are they don't have a lot of experience, because as an entrepreneur, like if you're going through a seed round of funding, like, you know, what your projections are 5 years later is completely irrelevant. Completely irrelevant. It's very unlikely that you will, first of all, even be in that same line of business 5 years later, right? Your idea now, it evolves into something completely different. You have no clue what you're going to do 5 years later. And so investors are asking like really menial questions in a seed round, and they're angel investors. That's a red flag that they're probably not like experienced or professional investors. And then the problem becomes, okay, so even if you decide to answer those questions, and even if they somehow decide to give you the money, despite what you're saying, which is true, and I agree 100%, but somehow you answer all the questions and they, you know, reluctantly decide to give you some money, they're going to be calling you every week wondering how their money is doing. And not only are they going to be calling you every week, but when you need to get them to sign stuff, they're going to ask a million questions. It becomes a huge pain. So that's really the biggest problem about having a lot of investors.
Yeah, I'll just add to that. I think definitely can be too many investors can be an issue. So how do you manage that? I think one is from a documentation standpoint, you try to constrain how many things you need people's signatures for, and that's really easy to do. I've taken the approach at NatureBox, like I don't want to hurt cats, and so you know we need very few signatures on things, and it's just you just put it into the docs, right? And if people have questions or if they don't want to invest, that's their choice. The second thing is as you mature as a company and you have professional investors around the table, you can make one of those investors your lead investor, and you know whenever investor shareholders have questions, you can try to navigate them to your lead investor and just say like, hey, you know, look, I'm really busy, you know, running the day-to-day, but our lead investor is going to take the lead on, you know, whatever this matter is, and you know, please work it out with him or her.
Cool. Do one more question. Somebody who hasn't spoken yet. Okay, Sarah.
You were talking about in the West Coast about overvaluation, and everyone they start building a company and they're going for a funding round, they tend to overvalue. They're going for big valuations. So my question is, so the speaker that spoke before, Paul Lieberman, he was talking about how competitive investors are good because you know when they compete against each other, you get better rounds. But then how do you balance that if investors are competing, the valuation's gonna go up. So at what point do you stop and say, that's enough, I don't want to be undervalued in my next one?
So, a couple things about valuations, right? If you get a really high valuation now, right, from like competition, and then you don't deliver, and you start running out of money and you need to raise money, I mean, this happened to Foursquare, everybody who's heard of Foursquare, right? What happens is, you get really, really highly valued, and then you try to go raise money, and in the next round, investors, you need to, the idea is you want to have a higher valuation with each round that you raise, and the reason why is you give up smaller amounts of equity, so on and so forth, right? So you don't like give up all of your company. Now the problem with a higher valuation is twofold. One is for future rounds. When it comes to future rounds, you need to make sure, and again, valuations and terms are two different things. So you might get a really high valuation and really crappy terms, but having competition helps you get better terms too. But so, say you raise a Series A round with a like ridiculously high valuation, right? If you don't deliver on that, like being able to do what you claim you're going to be able to do, right? And not even just claim but just from a market standpoint, you need to be able to. If you're worth $50 million, you can't have like, you know, no money, no revenue. I mean, unless you're a social media company, you have 1 billion users, right? And they assume that you can. But even that, I mean, look at Foursquare again, right? And so the problem becomes in future rounds, if you can't get a higher valuation in the next round, you get a down round. And that dilutes previous investors and it dilutes you and it makes your company look really, really bad. And it pretty much guarantees really crappy terms. So that's the first issue. The second issue with really, really high valuations is, and this is actually becoming a really, really big topic because of the number of unicorns. Guys heard the term, billion dollar valuation. So there's a difference between a $1 billion company and a $1 billion valuation, right? $1 billion valuation is not necessarily a $1 billion company. Somehow we have a lot of $1 billion valuations happening right now. And so the problem becomes the exit strategy, right? So typically a venture funded startup has two options for exit. One is get acquired, the other one is IPO. Right? Investors are expecting a return. If you don't need investment, you can have a lifestyle business, you don't need to exit, right? But investors typically expect an exit, and usually angel investors expect an exit sooner because, you know, they put in money, they have less money, they want that money back soon. Whereas like VCs are willing to wait a bit longer and hope that you IPO. But the problem with really high valuations is it doesn't necessarily meet what is actually happening in the company. And the higher your valuation, the harder it is to exit. So once you're at like $1 billion $1 billion valuation, it's very hard to find someone to acquire you for that amount. Because there's just not that many companies that can afford to pay $1 billion to acquire a business, right? So like there's, you know, probably several hundred companies that can acquire you for 500 million, then there's like smaller amounts that can acquire you for $1 billion, and then as your valuation gets higher and higher, like Uber, there's literally, the only option is to IPO. The problem with IPO is the IPO market is a lot more like stringent on what they expect your revenues to be versus your, you know, losses, right? So if you're a $10 billion valued business, but you're making only a couple $100 million in revenue, when you go to IPO, you're almost by default going to end up with a down round, right? Because the public market is not going to accept that sort of valuation. And so all of those investors that invest in later stages at $10 billion are in essence losing their money because it's going to come out as $1 billion.
Except they have liquidation preferences. Which
Right.
makes it a
Well,
little more
so then
complicated.
no, but then you're screwed, right? Then the
Yes,
founder
but the investors don't get screwed because of the liquidation. We can talk about that.
Right. So then your real like only option then becomes raising more and more money until you can get to the point where you can, you know, squash that difference between, you know, what you're making and what you're losing. Right? So again, this is going on like a deep rabbit hole of like valuation stuff like that, right? But in reality, that's the challenges of valuations and why it's not necessarily always good to be valued at, you know, a lot more than you're really valued at, you know?
I think that the easy answer, there's no easy answer, but what I would do, I guess if I felt like I was getting a valuation that was really too high and could mess us up for a future round, I would take the money, take as much money as I can at that very high valuation, but I wouldn't spend it that quickly. Give yourself the time to be able to reach the milestones that you need to either do that next round or achieve profitability. Just because you're raising a ton of money doesn't mean you need to spend that ton of money really quickly. Having the money though at a really good valuation is not a bad thing as long as you're responsible with it. So I think that's the easiest way to overcome it. I wouldn't say that it's in your best interest to take a lower valuation necessarily. It's more about how you spend it.
Yeah, I just really quickly add, because I know we're running out of time. I think it also depends on, as a founder, what do you want, right? Because to Polina's point, if you raise a really high valuation and your investors are expecting an even higher valuation on the exit, that might mean that you can't sell the company even when you want to sell the company, and it could be a life-changing event for you. And so, you know, I would say the only, the downside,